Hi, my name is Jamie Dempsey, and I'm going to teach you about stock valuation. More specifically, I'm going to teach you about the DCF model approach, or discount cash flow. Free cash flow to the firm, or FCFF, is measured under the DCF approach, and it's mainly used to measure the cash a company has available to pay investors after the company pays its cost of doing business. Investors include both stockholders and bondholders. Just to give you a quick look at what the formula looks like, free cash flow to the firm equals EBIT times 1 minus tax expense plus depreciation minus capital expenditures minus change in net working capital. A positive FCFF would indicate the firm has cash left after its expenses, while a negative FCFF would indicate that the firm has not generated enough revenue costs to cover its costs in investment activities. Now, let's break down the formula. We said FCFF equals EBIT. So, what is EBIT? EBIT stands for earnings before interest tax. It measures all expenses except interest and income tax expenses. It basically is the difference between operating revenues and operating expenses. You then times this by 1 minus tax expense because, as I just mentioned, EBIT doesn't take taxes into account. The next step that we want to do is to add depreciation. Now, some people might think, wait a minute, why do we add depreciation? Because it accounts for capital spending. However, we are measuring money being spent right now, not transactions that happened in the past. This completes the first part of the formula, which can also be known as operating cash flow. Now we want to subtract our capital expenditures. Capital expenditures are funds used by a company to acquire or upgrade physical assets such as property, industrial buildings, or equipment. Capital expenditures are found by subtracting fixed assets of year 1 minus fixed assets of year 0 plus depreciation. And this takes into account the company's ability to measure long-term liabilities. Lastly, we want to subtract change in net working capital. In order to calculate change in net working capital, we take current assets of year 1 minus current liabilities of year 1 minus current assets of year 0 minus current liabilities of year 0. This accounts for the company's short-term liquidity or its ability to cover its short-term liabilities. Now let's move on to an example. In 2012, Apple had EBIT of $5,000, depreciation expense of $2,166, and interest expense of $1,000. At the beginning of the year, net fixed assets were $10,374, current assets were $3,648, current liabilities were $2,052, and total liabilities were $5,000. At the end of the year, net fixed assets were $11,058, current assets were $4,389, current liabilities were $2,394, and total liabilities were $7,000. Given the tax rate of 30%, what is FCFF? So first thing we have to do is find EBIT, which is given to us of $5,000, times 1 minus the tax rate, which they give us is 30%, plus depreciation expense of $2,166. Now to find capital expenditures, we want to take fixed assets at year 1, which at the end of the year, fixed assets were $11,058, minus fixed assets at year 0, which are $10,374, add back the depreciation, which we already said was $2,166, to get $2,850. So we want to go up here and subtract $2,850. Finally, to do change in net working capital, you want to do current assets of year 1 minus current liabilities year 1. So again, at the end of the year, current assets, current liabilities, minus current assets year 0, minus current liabilities year 0. So current assets, current liabilities. And once you subtract all those numbers, you get a total of $399. So you want to go back up and subtract $399 to complete the equation. And your answer you should get is a free cash flow to the firm of $2,417. Now you guys know how to calculate free cash flow to the firm, and thank you for listening.